Okay. I am making some adjustments on the fly, so please bear with me. Okay. Okay, so I'm going to click through really quickly, but again, Delora, I want to thank you for giving us this opportunity to come together today. We know that it takes a village for us to be able to be successful, and it takes a community. And I'm very fortunate that I have a huge community in the assessor's office. And I want you to know that today we have two other people that will be joining me, Miss Crystal Taylor and Miss Jackie Irvin. You can see many of their accomplishments that are listed here. And so between us all, you have more than 100 years of assessment information and education and experience. And our goal is to share as much of that as we can with you all today. So we are going to give a disclaimer. We work for the assessor's office. We are not attorneys. And so we just want to give you that caveat. This is for informational purposes, but we believe that the information we share with you will be very beneficial to each of you. Okay. So the first thing I want to talk about is exclusions and exemptions. There are several of them. And again, there's lots of things that have happened, even in the near future, in the recent future, I should say recently, that have changed how and what is available for you in terms of property tax exclusions. And we want to make sure that we can educate you on some of those things. So the first thing I want to talk about again is we want to hit these different areas here. We want you to have a good understanding when you walk away from this webinar in terms of just the basis of property tax assessments. A lot of people don't know that the assessor's office is just one of many departments that's a part of the property tax system. In addition to us, the assessor, we also have the auditor and we have the tax collector. So these are the three primary branches that essentially give you your value, which ultimately turns into an assessment, which gives you taxes. And then also as a part of that, there's direct assessments, et cetera, that give you lots of the services that you utilize within your community. So that's another reason why property taxes are so important. We also want to make sure, again, that you're aware of the exclusions and exemptions that are available to you under property tax and revenue and taxation code section. We want you to be able to anticipate when you build something on your property or you transfer your property, what can you expect? What might be the ramifications of that? And we also want to reiterate the importance of understanding the deadlines that are really important. Sometimes if you miss a deadline, it can be very consequential. And we want you to be able to make sure that you understand those timeframes and so that you're able to meet all of those deadlines. Okay, so what I'm going to talk about first is something that we call Proposition 58. And it was, and it still is, a really important exclusion that's available. So, however, when we talk about this exclusion and the requirements and what's allowed, many of these are only available if we're talking about transfers that happen prior to February 16, 2021. And we'll talk about why. So for Prop 58, what it allows you to do is it allows you to have a property tax base. So let's say my mom owned her property. She purchased it in 1976. And so we can imagine at that point in time, properties cost a lot less, right? And so she bought it, and let's say she bought it for $11,400. I was just listening today about the history of Willowbrook, and they were talking about when those homes were built, they were going for $11,400, if you can imagine that. That was in the 50s. But what would happen is essentially she'd have that very low tax base. It does increase based on a CPI or consumer price index every year, but it would still be very low as compared to someone else who purchased their property today, right? So from a property tax standpoint, your tax basis is established when you purchase the property. So that's why you could have two exact houses next to each other, and one person's property tax base may be very low. Someone else might have purchased the property last year, and there would be a difference. The reason why this exclusion is so important is because it allows you, or a parent or a grandparent, to actually take that low tax base and transfer it to their child when they give them the property. But for the grandparent to grandchild option, what's really important is the parents cannot be alive. So if Big Mama wants to give the property to me and my mom is still alive, I can't get that exclusion. It's also important to know that with this exclusion, when we talk about transfers between siblings, so if I want to give my property to my brother, we need to realize there are no property tax exclusions. So again, if a grandparent transfers the property to their grandchild, there may be exclusion if the parents are not living. For a parent to child, and this is under Prop 58, exclusion may apply. That's the greater number that we get is a parent transferring the property to their child. It could also go the other way, but generally speaking, parents are transferring property to their children. Okay. So the other thing about Prop 58, which is really important, is it didn't matter what type of property you were transferring. If it was my principal home or my mom's principal home that we grew up in, we could transfer it and this exclusion could possibly apply. The other thing is, let's say if my parents had a corner grocery store and they wanted to transfer that property, we could also have an exclusion for that. If they had a warehouse, barber shop, those types of properties also qualified under Proposition 58. Okay, but what happened? In November of 2020, and I say we collectively, because the majority of people in California passed Proposition 19. And you all might have remembered this. These were the ads that said, hey, if you pass this proposition, we'll be able to give money to the firefighters. And it happened to be a firefighter season. This was also the ones where it said, hey, if you do this, you'll be able to transfer your property. If you're, an older person and you want to move, you'll be able to do it. Anyway, it passed. But what many people didn't realize was there's two aspects of Prop 19. One aspect of it deals, again, with these intergenerational family transfers. And what it did was, for this portion, it actually gave you less benefit. Many people did know that. So when it comes to it in terms of the relationships, the relationship portion of it stays the same. Grandparent to grandchild, if the parent is still alive, there's no exclusion, it doesn't exist. There's still no sibling to sibling exclusions. And then so we go to these other relationships here. If the grandparent and the parents are not alive, like we said before, an exclusion may apply. But the difference is here. If a parent has their principal residence and they want to give that home to their child, they only get an exclusion if the child or one of the children moves into the home. That requirement did not and does not exist under Prop 58. And not only do they have to make the property their home, we'll talk about it later, there's other timeframes that are really important for that. Oops, sorry about that. My apologies. Okay, so those are some of the key things, right? Again, there's a residency requirement and there's also a cap. So under Prop 58, if my parents gave me their home and I said they had this very low tax base, let's say they were only paying taxes on a $60,000 tax base. I mean, for an assessment. But the house was worth, now we know prices have gone up quite a bit. It's worth $1 million. In that instance, under Prop 58, I would still get the 60,000. Even if their house was $2 million, it wouldn't matter. But under Prop 19, there is an exclusion limit. And essentially, we usually think about it, if the primary residence or the home is less than $1 million, you can get their base. If the home is worth more than, and by worth, I said, if you put it on the market and you were to sell it, it's more than $1 million, then we have to do some calculations. Okay, one of the other things that's really important is, again, we're talking Prop 19 now, is that you are now required to get the homeowner's exemption or disabled veterans exemption. Because remember, If my parent gives the property to me, I actually have to move into the property to avoid the reassessment. And I have to apply for this. Okay, so that's really important. This is not an automatic exclusion. So let's talk about what that might look like. So again, oh, and the other thing that's important is to get the full exclusion, you have to do all of this within 1 year. Okay, so let me give you an example so you can kind of see what the math might look like. So in this case, I have Mr. Willie, and he has his son Jackson. Now, Mr. Willie, his property is assessed right now at $400,000, okay? If he were trying to sell it, it would sell for $900,000. Now, what happens is Jackson, in this case, his father, in this case, Mr. Willie just decided he wanted to move to Florida. And he transfers the property to Jackson. Jackson moves into the house within 1 year. He files for a homeowner's exemption. He fills out his Prop 19 exclusion claim form. It's approved. And so in this instance, since the property is less than $1 million, Jackson is going to retain his father's property tax base of $400,000, which is a big difference from $900,000. If Jackson did not qualify, he would have been paying taxes on an assessed value of $900,000. Let's do another example. Here we have Miss Linda. Miss Linda, her property again is assessed currently at $400,000, but her home, if she were to sell it today, is worth $1,600,000. Now, this is obviously more than $1 million, and so we're going to have to do a calculation to see what the property should actually be. In this case, again, more than $1 million, and the way we do this is we have to say, let's look at this. The home is worth more than $1 million, and we say by how much? So it's $1,600,000 if I look at the market value. But if I take the $1 million plus her current assessed value of $400,000, I subtract them, and there's a difference of $200,000. So that means Miss Linda's daughter, Jackie, is going to get her mom's tax base of $400,000, but we have to add in $200,000. So her new tax base is going to be $600,000. Now, in this case, she's paying more than what her mom paid, but she's not paying $1,600,000 on assessed value of that amount. So you can see there's still a benefit to it. It's just that if the home is worth more than $1 million plus the current assessment, we're going to make an adjustment. Okay. Now, again, in this case, Jackie did all of the things. She filed, she actually is a disabled veteran. She had that claim. She put in the Prop 19 claim form. She moved into the home within 1 year, and she met all of the requirements. Okay, so I want to talk about just generally, when we start talking about Prop 19, these types of values, we first talked about the ones that we call intergenerational. That means I'm going to transfer the property to another family member. And in this case, we know it can only be the grandparent to grandchild or parent to their children or vice versa, right? Do sibling transfers qualify? Thanks, Delora. No. Sibling transfers do not qualify, which is really important. Now, I have another question for you all. Can my parent transfer it to for all of my siblings? Yes. So if my mother had the property and she wanted to give it to all of my sisters, she could do that. But at least one of us would have to move into the property. Okay, so there's 4 of us, but one would have to move into the property. Now that was intergenerational. The other part of this Prop 19 that happened, again, we collectively voted for in November 2020 and became effective in February 16, 2021 for the family portion of it. A second portion of it is the base year value transfers. And these are important because if you're 55 years of age or older, That means if you have a low tax base and you want to move, maybe you want to move somewhere else in the state to be closer to your children, or maybe you just want to move because you always wanted to live in another part of the state. Now, because of the changes in Prop 19, you can do that. If you're 55 years of age or older, if you have a certified disability, or, which has been very relevant today, is if there was a governor declared natural disaster or wildfire. And so when we look at Eaton and Palisades, unfortunately, we had devastating impacts to those families. They could use Prop 19 if they chose to go ahead and move their tax base to another property. So we're going to kind of talk about, what are the rules and what does it look like? First of all, what is different from what was before, because actually there was a base year value transfer exclusion that existed before. However, it did not allow you to do this more than one time. Now under Prop 19, you can do it 3 times. And it also you could only transfer your base year value either within Los Angeles County or to other counties. And there was only about 10 other counties that would allow you to do it. Now, every single county, all 58 counties in the state have to accept a base year value transfer. Okay, so the other important piece of this is that there's also a value test for this one as well. So again, I told you that base year value transfer exclusions existed prior to Prop 19, but one really important caveat is prior to this change, you could only do it if the property that you were buying was less in value. So by that, I mean, if I sold my property for $900,000 and I bought another property, it was $1.2 million, can't do it. It was greater than. If I bought a property and I sold my property for $800,000 and then I bought something for $700,000, I could do it. So basically it had what was called an equal or lesser than criteria. Prop 19 changed that. Prop 19 says the value can be greater, but if it is, we're going to have to make an adjustment. So let's kind of go through an example of that. So again, we're going to go with, here is Miss Mary and Ernie. And they always said they wanted to live in Northern California. And so currently for the house that they live in right now, it's assessed at $400,000. But they said, we're going to live our Bay Area dreams, right? So they sell their home and they get $1 million for it. And then what they decide to do is they purchase in Northern California, and the home they purchase is $800,000. So in this case, we can see that what they purchased is less than what they sold their home for. And so when they move to the Bay Area, their tax base is going to be the same. They're going to move that tax base up to Northern California. They still have to, and this is really important, you have to apply for this exclusion. You have to give proof of age because they're qualifying because they're 55 years of age or older. And so they're going to make sure they give us all the documentation, et cetera. And then what will happen is the assessor's office in Los Angeles County will talk to the assessor's office up north and give information to verify it, and then it'll be processed. Okay. Now, the other thing is too, if Miss Mary and Ernie wanted to buy in Northern California first and sell their home in Los Angeles County second, they could do that. But the important thing is either if they're buying or selling and buying, both of those transactions have to happen within 2 years. The other thing is if they purchase the other home first in Northern California and sell later, they will initially be assessed at $800,000 because you can't have a low base on both of them. But once they sell their other home, then they would adjust their taxes down if they qualify. Okay, so both transactions have to happen within 2 years. Either one can happen first or second. But if you buy first and sell later, you're going to have the higher value for a little bit until you sell your home. Okay. So let's now talk about Miss Dora. So I have Miss Dora here. Miss Dora has her house and it is for 400,000. Okay. She sells it for 1 million and she still wants to stay in Los Angeles County. She just said, she's always had a dream house. She wanted to live in that bigger house on the beach and she's going to make it happen. So she does. So in this case, when she buys her house, she buys a house that's worth 1,500,000. And then she says, hey, I deserve it. I've worked hard all my life. I've saved my money. I'm going to give this to me. So, she's saying that maybe afterwards, but right now that 500,000, she's going to invest in her good living right now. Now, in this instance, when we look at this example, though, the key is Ms. Dora went from 1 million to 1,500,000. So her house is worth $500,000 more. So when she goes, and again, she files for all the paperwork, she gives us the Prop 19, she tells us she's over 55 years of age or older, etc. She goes through all of the different things. And in this instance, what's going to happen is that we see that her tax base is not going to be 400,000 because she bought up. But what we'll do is we'll take the 500,000 difference, we'll add it to the 400,000. And in this case, her new tax base is going to be 900,000. Higher, but it's not 1,500,000. Okay, so there are other base year value transfers, and I want to talk about them a little bit because again, if we're looking at this information and we know that unfortunately many people were impacted by the wildfires that we had in the first of this year. And so there's other ones that exist is Proposition 50. This one in particular could be for all property types. So again, we're not just talking about someone's home, the family home. This could be commercial property they had, et cetera, retail. They can apply for this one. But the key is that it has to be substantially damaged. And by substantially damaged, we mean 50% or more of the property was burned or whatever the disaster is destroyed. Again, this one is within Los Angeles County. And then the other thing is that in this one, we always have some kind of test. This one means, let's say the property that burned down the day before the fire, it was worth $1 million. We can get something that's up to 20% more. So if I'm saying $1 million, that means that they could buy something up to $1,200,000, and then they would transfer over their low assessed value. If they did something that was greater than that, they could still use it. But for anything that was above the 120% value test, that would be reassessed. Okay. The other thing is with this one, there is a time limit for them to either reconstruct or buy something new for new construction. So let's say if I bought vacant land and I was going to construct something on that vacant land, I could do it. The other thing is too, you do not have to sell the old property. You could maintain both. So in this case, let's say my property burned down. I buy something else within the county. I bought vacant land. I build the house. After it's all done within 5 years, the market value of it is still below or at 1,200,000. Then I could transfer my old base year value once I complete it and take care of it. And then for the old property, what would happen is at that time, the remaining value would stay. But let's say I decide to go ahead and build something on that old property, whatever I build on that old property would be reassessed at the fair market value. So if I built a $3 million replacement, then that would be added on to it. Okay. The other type of exclusion I want to talk about that could be available is Proposition 171. This is also a base year value transfer. For this one, again, it's only your principal residence. We're not talking about other types of properties. We still have substantially damaged, which means more than 50% of it was destroyed or damaged. This one actually can happen and you can transfer this in other counties, but I think there's only 13 other counties. So this is not statewide. You'd have to verify that the county that you're moving to is participating in this in this type of exclusion. Okay, so that would be really important. You couldn't just move to any county and assume that you could use this exclusion. And then there is a replacement value. The 105, 110, and 115 depends on the year that you do it. So basically, on this one, you have a shorter period of time. You have 3 years to actually do this. And the reason what they do is assuming that costs may go up annually, then depending on when you purchased the other property or constructed, we would add that fudge factor of 5%, 10%, or 115%. But it would still be comparing the value of the other home to the value of what you're actually getting on the other side of it. Okay, so that was a lot of information. We'll have some opportunities, to answer some questions on the end, but at this point in time, I want to talk about something that a lot of people don't know. And of course, when someone passes and they own property, family members, probably one of the last things that people are thinking about is property taxes. But unfortunately, it can be very consequential. So I'm going to share some things that you may not know about when a property transfers. So first of all, when a property transfers, you have to contact the assessor's office. Most people don't know that. If the property owner or the decedent owns property in Los Angeles County or anywhere else in the state, you need to contact your local assessor's office, and they will ask you to complete a form called Statement Death of a Real Property Owner. The other thing is that most people don't know is that that is supposed to happen within 150 days. And that can be very consequential. And I will tell you most of the time, and I can say this in the African American community, we typically do not meet that standard. And so I will tell you when it comes to the Eden fire, I'm really concerned is because I can look at those properties and we have data that shows that a lot of people have what's called a 1975 base year value. That's the lowest base year value that you can have, which means that someone purchased property prior to 1975 or within 1975, and they had that very low tax base, and it hasn't changed since then. When I say it hasn't changed, they haven't transferred it, it has trended up, but they basically have that low base value. What I can tell you specifically in Eden is we have about double those types of base year values that we have in other parts of the county. We would think that's great. The problem is we probably have double because we have what we call unreported transfers. That means someone probably passed away and we never heard about it. The problem with that is, we'll talk about that a little bit later, is that could result in lots of tax bills coming to us. So the key is within 150 days, we are supposed to be notified. And the other reason why this becomes important is you can imagine if we're not finding out about some of these things until 2 years or 3 years or 5 years later. Remember when we talked about Prop 19, that exclusion, and we said that if you wanted to get the full benefit, you had to move into the property within 1 year and file a homeowner's exemption? So by not reporting and by not meeting those requirements, you may cause a reassessment of that property that's unintentional, and you may either get prospective relief only or get no relief at all in terms of exclusions. And so if that happens, that could be the case where we saw the property was maybe 1 million and the parents had the 400,000. You may have inadvertently changed your tax base to $1 million going forward. And there may not be anything that can be done about it. When our office is notified timely about changes in ownership, whether they be a death or just a recordation of a deed, or maybe just a transfer that wasn't recorded, if we think that there's an exclusion that you may qualify for, we will send you claims or we'll be aware of it. If we're not aware of it and you're not aware of it, you may miss those very important deadlines. So it's really important that when someone passes, that you contact us and let us know. And so let me give you an example. Let's say someone passed on the property 10 years ago and it was never reported. Once we find out, Revenue and Taxation Code section says that we can go back for 8 years. Now, what happens when that reassessment gets processed, it's different when you get one tax bill every year. I know for many of us, if you own property, you get tax bills. No one's looking forward to getting that tax bill. But can you imagine if you were going from 400,000 to $1 million? So essentially, if I was going from maybe 6,000 to maybe 12,500 in taxes, and not only would I get the one bill, but I got 8 bills all at one time, that would be tax bills over $96,000, almost $100,000, all due at one time. So you can understand why it is so important to let us know timely, so that if there are exclusions that apply, you can get the information, you can apply for them. Or even if you were going to get reassessed, it's usually easier when someone dies, when they're still working through the estate and everything else, to deal with those things at that time versus waiting 10 years later and then trying to address it. So becomes really important. Okay, so like we said, we are not attorneys, but we do think it's important for us to talk about the ways and the methods of people and how they hold title. Because it's very consequential, one, for, estate planning. It's very consequential for liability, et cetera. But it also is something that can cause a reassessment for us as well. For this part of it, though, I'm going to go ahead and I'm going to turn it over to Miss Crystal Taylor, who is going to unmute, and then she's going to go ahead and share some information with you all about the different ways that people generally hold title for their properties. And she will talk about some of those things in terms of how they relate to our office. Crystal, you are still muted, though.
Good
Thank
morning,
you.
everyone.
Good morning.
Okay,
Good morning.
usually when you are purchasing a home, you have to decide on how you want to hold title. There are several different ways of holding title, and we're going to go through a few of them today. The first one is sole ownership. This is when a property is held in one person's name. There is only one owner, and only that person has the exclusive rights to make decisions regarding this property. No one else has a vested interest in this property. So no one can come down and say, well, they come down and change the name or anything like that. It's one person and one person only. The next method is joint tenancies. Joint tenancy, you can have two or more people who have equal shares and equal rights. They also have rights of survivorship. So if the property is owned by Nicole, Jackie, and myself, we all own 1/3 equally, 33.1% of the property equally. If one of us were to pass away, that interest would be divided among the other two. Rights of survivorship also means that there is no need for probate. It automatically goes to the other two. This form of holding title is usually commonly done by married couples and family members, because you really want to have someone you trust as your joint tenant. There are some disadvantages to this, and we will talk about them later. The next method is tenants in common. Tenants in common can be with two or more people who have equal or unequal interests, which means I could have 20%, Nicole could have 40%, and Jackie could have 40%. We are each responsible for our own interests, which means we can transfer it. We can leave it in a will to whoever we want. And in some cases, we can also get a mortgage on just our interests of the property. This method is commonly used by business partners, some individuals, and some investment groups. You can leave your interest to a person, to a business, or to a charity. Each owner can make their own decision regarding their own interest in the property. Our next message is community property. Community property is held by married couples. They can hold community property with or without rights of survivorship. If the property is acquired during the course of the marriage. If the property is acquired before the marriage, there are some common law requirements, but you would have to go to court. If you have community property without rights of survivorship, it is similar to tenancy in common, only it's with married couples. Each spouse is responsible for their own interest in the property. So the husband can leave his half to his children, his family, and the wife can leave her half to her children or her family. If they have it with rights of survivorship, the property will automatically go to the surviving spouse.
Chris, just one thing really quickly. My apologies. I made a mistake for the tenancy in common. It should say they have a divided interest in property because they're distinct interests. So it should not say undivided on that slide. It should say divided.
Okay.
My apologies.
I think I said that.
No, I just know that I have the wrong words. So Delora, before we give you the deck, we'll make that correction. I just want to make note.
Okay, we're going to talk about the advantages and the disadvantages of joint tenancies. One of the advantages is the property automatically transfers to the surviving joint tenants. There is no need for probate. Probate can be time-consuming and expensive. So this is an automatic transfer, and you will avoid those expenses. Each tenant holds equal shares in the property. So everything, as far as the beneficiaries, it's fair. I leave it to my 3 children. They own the property equally. If you pass away, you cannot dictate who the property goes to. The property goes to the surviving joint tenant. However, if that joint tenant had any financial problems, the creditor can go after the surviving joint tenant. All joint tenants must agree when selling the property. If a disagreement arises, there may be legal complications. So joint tenancy means that we are all on the same page. We all in the same accord, and we all have equal interests. We all have equal rights. I'm ready for the next slide. Trust. A trust is a document where a person puts another person in charge of their property. The other person is the trustee. The person creating the trust is a trustor. The trustor transfers the property to the trustee, who is the overseer of the property. The trustor may give the trustee the power to handle the property during their lifetime or only upon their death. It depends on how the trust is written and what is said. There are also two types of trust. There's an irrevocable trust and there's a revocable trust. A revocable trust means the trustor, the settlor, the creator, the grantor has the right to change the trust whenever they feel like it. If they decide they want to leave the property to their 3 children, and then they just fall out with one of the children, they can change the trust and leave it to only 2 children. In an irrevocable trust, the property goes to the beneficiary at the time the trust is created. An irrevocable trust can be for the benefit of the trustor, but it is still unchangeable until it passes to the beneficiaries. You can have a person, an individual, a bank, or any other legal entity be the trustee of your trust. They are just the overseers, and they will do the wishes of the trustor. I think I covered everything. Did I miss anything, Nicole? I was all over the place.
No, it's all good. You did a great job. So I just want to just really tie some of these up. Why are we talking about, why is the assessor talking about this, and why is it important we share this information? So I'm going to go back really quickly. One of the reasons why we're talking about joint tenancy is because this is probably the majority of documents that we see. And so I should let you know, whenever you record a document with the Registered Recorder's Office, those documents come to our office. At that point in time, we have to decide if we're going to assess or reassess, assess or not reassess. And so most of the time we see joint tenancy. And Crystal went through all of the advantages and disadvantages of that type of title and holding property in that manner. Of course, if you're going to be doing something, if you're going to be purchasing property, if you already own property and get married, you know, it's really important that you're talking to an attorney, because again, when you buy this property, maybe you have thoughts about when you die, or where you want that property to go. How you're holding title will dictate what that looks like. Like we said, some of these things will either maybe result in probate if you don't have a trust or a will, or they may be automatic. And so when you talk about rights of survivorship, that's really important. When we talk about community property, that becomes really important. And she talked about a little bit, if you own the property before, if you purchased it within marriage, again, you should be talking to an attorney, because those type of things, there's lots of rules associated with them. But it might be important. Let's say you have property and then you get married, and then you want to make sure it goes to your children. Then that means you need to do some estate planning, if those are your wishes, and have those discussions. But from a tax perspective, it's important, because if you own a property in joint tenancy, let's say, like Crystal said, Crystal has a property. And we saw this a lot when Prop 19 happened. Because people were trying to make sure they did their transfers before the law changed, they decided that they wanted to add their children onto their property at that time. Okay, so I'll talk about myself. Let's say if I had a son named Brandon. Let's say Brandon is 25 years old. And, you know, before Prop 19 came on, if I did anything before February 16, 2021, maybe I said, I want to make sure Brandon gets the property. I don't want to get reassessed. So I'm going to add Brandon onto my property as a joint tenant. There's a couple of things too that people didn't understand, and lots of people did this. One is I had to realize I'm adding my 25-year-old son to my property. Well, I've created a lot of liability because now, let's say, for instance, something happens and Brandon gets sued. Now, all of a sudden, he has an asset that they could go after. That was one thing. The other thing is that most people don't understand is when you add someone onto your property as a joint tenant, if I own the property and I add them on, at the assessor's office, we will not reassess the property at that point in time. But many people thought that they were actually getting an exclusion that was permanent. But when I pass, or if I give all the property to Brandon, at that point in time, it gets 100% reappraised. There's no exclusion that's going to go beyond that. And so a lot of people did that thinking they were avoiding the Prop 19 changes. They just don't know, they've just pushed it down the line. So that becomes really important. The other thing is why we talk about trust, because we think that it is an important tool. People should be thinking about that. Again, I'm going to say you should talk to an attorney, but if you have a trust, the benefit of that is that potentially, a lot of times we talk about when someone passes away, but what happens if I get incapacitated? What if I'm in the hospital for a long time? What happens? So a lot of times we talk about wills, and there's other ways of owning property that, if I'm going to give you guys some links to get more information, those things will take effect when you die. But what happens if you're incapacitated? Lots of families, unfortunately, we've dealt with issues where maybe the person's in the hospital for whatever reason, they're incapacitated, and people are generally in limbo a lot of times if they don't have the right documents in place. And so we also talk about trust because, again, for our purposes, if someone decides, for whatever the reasons are, based on what they're trying to achieve, they want to get a revocable trust, then when you get those, you still need to contact our office so we can change it from your name to the trust. But generally speaking, when someone puts their property in a revocable trust, which means they can revoke what's in there and they can change it, we do not reassess those. However, if you decide, speaking with your attorney, that an irrevocable trust is the better way to go, many instances we will cause a reassessment at the time that it gets put in the trust. So that's really important. The other thing is, because we have to make these determinations, our office may contact you. We may ask you for copies of the trust. And lots of times people say, why do you need to have the trust? Because we actually have to look at the beneficiaries. We have to look at how should the trust be distributed, et cetera, to make our determination about whether or not we're going to reassess or not reassess, if we're going to reassess 100%, or if we're going to reassess partial interest in the property. So again, it becomes really important. Okay. So again, that's why we're sharing it. But today, what we really want to talk about is we want to make sure that you understand the connection, the bigger connection, just about generational wealth and how we can maintain it. But one way we can do that is if there is an exclusion or exemption that we are eligible for, we should be making sure we get it. Why pay extra property taxes? If you're talking about wealth, why would I pay more taxes than I have to, right? So you have to educate. And the fact that you guys are on this call today, you've started the process, right? You are understanding probably more than most people know about property taxes and assessments. First of all, you guys know that when someone owns property and they die, you need to contact I know you guys are all saying it, the assessor's office. Exactly. You know that it's really supposed to happen within 150 days, but if not, as soon as possible, right? That becomes really important. And then when it comes to home ownership, this is such an important part of it, because I'm going to tell you, lots of times what happens is someone buys a home, they go through escrow, and generally in escrow, they are paying taxes that are prorated on the old owner's value. And then all of a sudden they get, which we haven't gotten into, they get what we call supplemental tax bills, and they haven't accounted for them. Like, what is this big bill? I thought my taxes were going to be based on the old owner. No. When you purchase a property, we are going to reassess your property based on your purchase price, usually, assuming it's fair market value, it's open market. So if you had a realtor involved and you put it up for sale, whatever you purchase that property for, your taxes are going to be based on that, not the old owners. So that becomes really important. You also need to know, what are these tax bills going to be due? The other thing is that many people don't know is if we do an assessment, because let's say if you add something to your property, there's only two times we usually change your value. One, you purchase it, you do a transfer, someone dies, or you add new construction. If you add a new pool in the backyard, if you add a new room over the garage, we're going to reassess you. But what you don't know is that at any time you don't agree with that assessment, you can, one, contact our office and ask us to review that assessment. You can also, if you don't agree with us, go to the Assessment Appeals Board, right? But again, knowledge is power, and the more you know, and you don't have to know everything, you just have to know enough to ask the questions, right? And seek the answers. And so again, when we talk about estate planning and generational wealth for African Americans, one of the key ways that we have passed on wealth is through ownership and home ownership. And so for us to be able to do that, we have to, again, understand what types of actions may cause us to get reassessed. We have to understand when our taxes are due, so we're not paying undue penalties and interest, etc. So these are strategies, again, that become really important. I recommend that people deal with a estate planning professional. And by that, I'm saying someone separate that can talk to you about your specific cases, understanding what your family's needs are, understanding what your desires are. And one thing we don't do enough of is we need to talk to people while they are still here and understand what they want. Now, one of the things we often hear is mama says, my babies, I treat all my babies the same, and I want every one of my babies to get my property when I pass away. Okay, that's fine. But let's say she says that, and you guys already know 3 of you own homes, and you're not going to move into that property. And you also know that you guys don't want to have joint ownership. That's not for everybody's family. But let's say you do. If y'all not, and you know that you're going to sell it, but one of you guys really wants that property. Let me give you a couple of quickie scenarios. Mom leaves the property to all 4 of us because she says that's what's fair, and that's her right. But 3 of those siblings decide they don't want the property, and they say they want you to buy them out. So let's say if there's 4, each one essentially has 25% interest, unless mama said something different. When the 3 decide that they don't want to be in the property and they want you to buy them out, and they give their interest to you, remember, sibling to sibling transfers are not excluded. We're going to cause a reassessment of 75% of that property. That can end up being a real big bill. So I'm saying what my point is that we need to think about what those things are and have those hard conversations, you know, and that can be a part of our estate plan. Maybe mom is going to say she's going to set it up so people can get other things besides that property, but she knows that one child who really wants to keep that family home, maybe she's going to make sure only that one child gets it. We don't get to make those determinations, but what I'm saying is those are things and conversations that should happen now, not on the other side of it, right? So we have to kind of understand that. Delora has done a fantastic job making sure that we have partnered with many organizations that can help people get into homes, right? But we need to make sure once we get into the homes, we are able to maintain and keep them and understand what that looks like, right? We also need to know when I put somebody on my property, that's not a small thing. Crystal talked about joint tenancy. Once you can easily put someone on as a joint tenant, you cannot just go record a deed and take them off. At that point in time, you need them to agree. They are on title. You don't get to just take them off. Oh, I recorded, I added Delora to my property today. You know what? I don't want Delora on the property tomorrow. I'm just going to go record another deed. No, she has to sign that document and agree to come off the property. So you have to understand that. And again, all of the liabilities, now someone has an asset that they can go after. So that's when Crystal talked about responsible people. You want to make sure if you're even, or if you say your friend says, you guys, I have this great idea. Let's just go buy this property. We're gonna make $1 billion. But let's all get on it. You all are going to be responsible for the taxes and the liability and everything else associated with it. So again, knowledge is power. So what do? We create a plan. And so there are lots of free resources. There's many more than this that are listed. I looked up just some of the free ones. AARP has some free estate guide, estate planning information. We do have some resources and tools that are available through Lacera for us as well, right, in terms of wills and things like that. The Los Angeles County Assessor's Office, I could not get off of this call without really promoting, not just promoting because I'm affiliated with them, because we have tons of information on trust. We also have information on all of these types of exclusions. We also have FAQs that will give you more information and guide you through the process in all the forms. And we have an extensive library of videos that go into this information. They reiterate it. They give you even more information about all of these different things. And so it's important. So again, you need to create what I know that everyone, if you don't have it, if you don't have a trust, if you don't have a will, we haven't even talked about power of attorney, right? We haven't talked about these different things about attorney in terms of if you are sick. Again, these are things that you can go through with Lacera, and you should go through them. And they become very important. You need to talk to someone should really know what your wishes are. Now, of course, you should make sure you have the documents, the important documents that are available. I would say talk with a estate planning professional. That may be key. If you're not understanding all that you need for your types of assets to maintain them, then you need to talk to someone who can help walk you through those types of documents. Generally speaking, people talk about a trust, a will, power of attorneys. These different types of things are key things that we should all be looking at. And you don't just create these documents and leave them alone. Times change. You may need to go back and revisit those documents and make sure they are reflecting your most current wishes. And you need to know who in your property owns family and who's on it. People are like, well, you know, grandma's house, I think Bobby them. You should know who's on the property. Unfortunately, when it came to a lot of the properties that are in Eaton, what people found is the person they thought was on the property or what they said grandpa wanted, there were no official records of it. What was the consequence of that? When it came to FEMA and other people who checked our records, if the ownership did not match, they were unable to get aid. So you realize at that point in time, unfortunately, it took a devastating act for people to realize a lot of things in terms of the estate plans of their elders had not been realized in an official way. Again, you can contact our office when someone dies. We know we're going to do that. And if you receive a letter, if you receive an email, again, from the assessor's office, if you're concerned, hey, is this really from us? You can always contact us. Don't just ignore it. You ignoring it may cause an immediate reassessment. And even if you get an exclusion, it may mean that you lose some of those years and you pay higher taxes for a period of time because you did not respond. Timeliness is important. And for some exclusions, if you do not respond timely or take the appropriate actions, you may lose out altogether. The other thing I'm going to say is before you record a document, understand why you're recording it, but also understand you may inadvertently cause a reassessment. And the other thing I want to say too is that the things we're talking about are for property tax purposes. There may be other reasons why you're doing something. There may be other consequences in terms of your federal taxes, et cetera. So you have to understand the implications of both. And the other thing is if you have exemptions, please apply for them. How many people on this call, if you own a property in the state of California, have your homeowner's exemption? That's a 7,000 exemption, and all you have to do is show that you own, fill out the form and submit it. And that means you're paying probably at least $70+ but it comes out to be more extra that you don't have to pay. Why would you not be taking that money and putting it aside or investing it if you're trying to increase your generational wealth versus just giving that money to the county? Now, give the county the money it's due, but you should not be just giving a benevolent offering of money that you don't need to, right? So you all have done great steps today just to learn about the property tax system. You know that there is no such thing, at least in Los Angeles County, as the tax assessor. The tax collector is a separate office. The assessor's office is a separate one. But you understand we all work together to actually give you your assessment, provide the property taxes, apply the appropriate direct assessments and taxes, et cetera. And then I want to say this, select accountability partners. What is that? Your accountability partner is going to be that person saying, wait a minute, Did you file those forms you said you needed to do? Do you have your will? Do you have your trust? These are people who can help walk you through this process. And right now on this call, we have all created a community where we are accountable because we have information that we are now going to make sure that we act on. So this concludes the formal presentation, Delora. I know we've gone over a little bit, so I appreciate you and I thank you all for sharing this morning with us. We will make sure that we have the slide deck available to you. We also have some other resources, but I'm going to also tell you guys, if you go back and you go to the assessor.lacounty.gov, and it's the third one here, you're going to find that there is a tremendous amount of information. We actually did a very extensive webinar when Prop 19 first came, and we shared information with people. And we also had outside attorneys that gave information as well. So there's a survey that is on the screen. I'm hoping that you guys will also take the poll, complete it, and I hope you understand and appreciate that these are the types of really important resources that our president and Lakea is making sure that we get to you. And if there's other questions, Laura, if those come back, we can make sure we get answers and get those out to everyone. And I want to thank Crystal and I want to thank Jackie Irvin for coming in today and helping us. You all just don't know how much of a gem they've been in terms of helping, being accountability partners, and also just being tremendous resources for me and for you all. So thank you.
Thank you so much, Nicole. So if you all could just do me a favor and use your reactionary keys and give it a round of applause for Nicole, Crystal, and Miss Jackie. The information here is great. I know that we could do more, and we will probably post this recording on our YouTube channel. So if you're not following Lakea on YouTube, go ahead. And if you know someone that missed the opportunity to be here today, invite them to subscribe to Lakea's YouTube channel and or visit and look at this recording. This is essential information and we all need to know it. Nicole, I don't know if we could take maybe 1 or 2 questions if you have the time. So if we could stop the share. And we will look in the chat to see, and if you can raise your hands, because we do want to give people, folks, the opportunity to ask any questions that they may have. It was a lot of information, and I know we're going to have to sit with some of it, but I love a couple of the takeaways about making sure we contact the assessor's office when we need to. We got 150 days to make sure we get that done. We also need to make sure we have an estate plan. And, you know, when we add some new stuff, because everybody been talking about adding the ADU, used to be called grandma, mother-in-law quarters and stuff like that. We probably need to contact you then too. But so those are the takeaways, but we do have a couple of hands raised and we're just gonna just trouble you for just maybe 2 questions. Let's start with Robin Daniels. Can you unmute yourself?
Hi, yes. I'm glad I got on this call. And I was actually going down there on Monday. I have a question on, I bought a house, and I have a nonprofit. So I bought the house for the nonprofit. It's in my name because I couldn't put it in my nonprofit name. So a couple of people telling me I can go down there and let them know I use the house for the nonprofit to try to not pay all the taxes that I'm paying. So I want to know, is that true?
So Robin, there's a couple things to that. So I would say you should go down to our property. There are other types of exemptions. We've talked more about the intergenerational exemptions. There's also what we call welfare exemptions. It's sometimes for specific property types. It depends on the use, et cetera. So I would go down there. There may be another exemption that qualifies, but again, you'd have to research that a little bit more. But definitely you should go in and you can go down to you can either go to the local office or you can go to our downtown office and you would just let them know that you're interested in finding out some of our welfare exemptions and exclusions that apply and see if they apply for your particular situation and case.
Okay, and where's the local office at in like close to Watts?
So for that office, would that be, Crystal, our southern office? What we're gonna do is if you go to our website, There is actually all of our locations are listed there. I think that would be the South District
That would
office.
be the South, Long
Yes.
Beach.
So if you go onto our website, again, assessor.lacounty.gov, I'm going to type it in the chat. You'll get all the information in terms of how to contact us. You can also, and I should have promoted this, we also have chats. So you can actually submit information online and we will actually answer your questions that way as well. You can put in all the particulars. So you can go into our office, but you can also type the information onto our information site and you can get information questions answered that way. Delora, there was one question that was in the chat though. I'm sorry, did I answer your question? Okay, perfect. There was a question that was in from Ms. Stinson that was in the chat, and she basically says that her property, she does not have a trust and she doesn't have a will, and she says, does her property automatically go to the child? So I'm gonna say no. So, and the reason why I'm gonna say that is because if you don't have a trust or a will, your property will be forced to go through probate. And there are what we call rules of succession in terms of how the property transfers, but you don't want to do that because one, probate is very expensive. And so I should say there are succession rules. So generally speaking, in California, if you die and there is nobody, there's no will or trust, you go through probate and then there's a series of rules in terms of who gets it. If you're married, maybe it goes to your spouse, etc. But you don't want to do that. It is very expensive and it takes a lot of time. So the best way, if you want your property to go to your child, is you're going to create a trust and a will to make sure that those wishes go or what happens. So that becomes really important. And unfortunately, again, we see lots of times where people are going through probate and that's not the only issue. The question becomes too, will other people challenge it in probate? It can become a very sticky situation. You don't want to go through that if you don't have to. And then the other question was, if you put the property, when the property comes out of a trust, is the property reassessed? It depends. The property can be reassessed unless there's an exclusion that applies, right? So yes, when the property comes out of the trust, it will depend on who the beneficiaries are that Crystal talked about. So depending on who the property is going to, it may be reassessed. Again, and if it's not going to parents and children and you're not meeting all those requirements and you're not applying for an exclusion, it most likely will be reassessed, just so you know.
Let me explain that
Sure.
just a little bit.
Okay, Ms. Chris.
The property actually transfers on the date of death. So if the property is held in a trust or if you have a will, upon your death, that is our transfer date. That is our reassessment date. You should file for your exclusion if it qualifies for a parent to child or grandparent to grandchild exclusion based on the date of death. When the property is actually distributed, when it's distributed from the trust to the heirs or from the will to the heirs, if it is transferred exactly as specified in the trust, there should be no reassessment. There's not a double assessment. That deed is just making sure that the property is going to the heirs as specified in the will or the trust. Is that clear? Delora?
Yes, it was clear to me. Thank
Okay.
you so much, Ms. Crystal. Tina Robinson had her hand raised, and so she would be our last question.
It was in the chat. I'm not sure if they answered it, but my question was regarding a homestead exemption, because I hear people talk about homestead, but I don't know, like, if you have a homestead exemption and maybe if one of the parents pass away and they've added, different things like that, will that affect anything? But what is a homestead exemption is basically my question.
Chris, do you have a good question for the homestead? We always get people talking about homesteads, and I know that they talk about in different areas how it provides some protection for them. I really can't tell you a lot about the homestead exemption. And when I'm talking about the homeowner's exemption, I'm really talking about something that's a little bit different in terms of property tax purposes, that you have to apply for directly with our office.
Okay, that's fine too. The homeowner's exemption. So you said there's a lot of exemptions. So just go on your website and get the paperwork in. Thank you. It was great information today.
No,
Appreciate
thank you, Tina. They're all on our website, and that's a simple one. You own the property. You can show that you live there. You get that one. That's what it takes. And those really become important for Prop 19 because now the rule changes. It has to, the person now who is moving in to the property, they have to have the homeowner's exemption or disabled veterans exemption to qualify. That's now one of the requirements. It did not exist under Prop 58, but it does exist under Prop 19.
Thank you so much, Nicole. So I'm going to take an action item for the association for us to look to find out what is being said about homestead exemption, because we do know that back in the day, everybody was saying homestead your property, and there's a lot of misinformation out there in our community about it. So Lakeia will take an action item, find some experts in this area and come back to this forum, because one of our main missions is to make sure that we educate our communities to make sure we close this wealth gap. We can do it. Latasha has one question. I don't know if her hand is up, and if we'll take this one as the last one. Latasha, would you like to put yourself on camera and unmute yourself?
Yes.
Thank
Hi,
you.
good morning. Sorry, I'm multitasking with the kiddos trying to get breakfast.
We understand. What you cooking? No.
Oh, Chick-fil-A.
Go ahead,
Don't
sister.
judge me. Okay, no, I was just saying, just really quick, I am a member. I just wanted to know, like, okay, so there's a parent on a property with a child. There's no will or trust. Parent passes. What happens to the property? Can a will and a trust be added after their death?
So in this case, let's say if there's a parent and child, you can't add the will and a trust after, but if you're on the property, if you own the property as joint tenants, that's how you hold the title. So Nicole White Gamble is joint tenant with whomever, that automatically has rights or survivorship. By that, it means it automatically goes to whoever the other joint tenants are on the property. So again, it depends on how you hold title, and that's why we talked about it a lot. Because if you own it as joint tenants, then without a will or trust, it will automatically go to the other person.
Okay, that's what I thought, because I was researching it, but it's good to hear from the experts. Because I guess I was on the fence, like, okay, because I know my mom's like, get the trust, but then, God forbid something happens. I always wanted to know, like, in the back, on the back end, what would happen if, something should happen, God forbid, and I don't have the trust or will done.
That's going to protect the house. Remember, you might have other assets and other things, though, that are not protected.
Okay.
And that's why it becomes important, right? So
Okay.
the joint tenancy and holding the home in joint tenancy protects that. But let's say this, and I hate to say this, but God forbid something happened to both of you all. Now what? You first have the properties in probate, and now everyone's in limbo.
Got it. So you recommend the trust in? Because I have two properties. So my other one, I do have the whole will and trust already done. So I'm just trying to protect myself.
I recommend you think about what that looks like. So if something happened to both of you guys, God forbid you guys are both in a car accident, then what would happen to your mom's property? Maybe you guys want to know what that happens. Otherwise, you have no control, right?
Okay. Got it. Okay. Thank you so much. Appreciate that.
Thank you for coming on camera. I appreciate you.
Thank you.
Yes. And we're not judging you with Chick-fil-A. So we're going to go ahead and relaunch our poll. We want to thank everyone for being here today. Please take a moment to take the little brief. It's only 4 questions. If you could please do that for us, and have a wonderful day. Stay tuned, and we hope to see many of you back here on April 25th at 7:30, where we'll be talking about 401ks and 457s. Thank you. Have a great one, everyone. Take the poll. Take the